Happy Tuesday, everybody. I hope you had a good long weekend. In case you thought you missed something yesterday, it was Juneteenth and the markets were closed. Today is June 20th, 2023, and this is your slightly delayed by Juneteenth Tuesday market update. Let's jump in and do a quick update of last week and what a packed week it was. I'll summarize the week in just a moment, but just a bit of the day-to-day. Monday, markets opened a bit cautious, but in the green nonetheless. CPI, PPI, and the Fed meetings were all on the horizon. There wasn't much other news, but there was some lower than expected Japanese CPI data and a down oil market, and that played into the disinflation narrative. Markets were pretty quiet until the New York Fed consumer inflation expectations came out midday, and they were also pretty tame, and aside from the longer-term outlook for inflation, markets stayed near highs until the end of the day when some short covering and retail investors chased the market into the close. There was a bit more stocks that participated, but it's still a bit narrow. Elsewhere, the VIX, the measure of volatility, is near historic lows. Complacency? Yes. Too much? Time will tell. At the end of the day, the Dow was up about 0.5%, S&P up just under 1%, and the NASDAQ up over 1.5%. Markets reacted Tuesday to the slowest CPI growth in 2 years. The core reading, not as good, but who cares about details? Markets clearly did not. There are concerns that once people stop watching the Fed alone, we'll see what happens. China data shows slowing. Venture capital and startups are failing at a pretty high rate. Consumer credit's still at record highs. The market's not even pricing in rate cuts again this year, and that should equate to lower profits and lower earnings in a normal world. But maybe since everything and everyone will seem to benefit from AI, maybe that'll account for all the lost profits and high valuations in the markets. I know that AI should increase productivity, but please recall, we have so many great time-saving tools that we have never had, and we still have less time to do what we need to do. We have more ways to stay in touch, but survey after survey tells us that we feel more alone than ever. Just saying, AI is not the panacea without a price. Seems that this is not a concern these days. Overall, on the support of the bull side, China's bringing stimulus to the table to assist the recovery and the growth there. PPI was due to come out Wednesday morning, then the Fed, and as I heard, Jay Powell has come to change his thought to the 2 p.m. Fed release. To the 2 p.m. is just 30 minutes before my press release, my press conference. New perspective, obviously. Markets got into position heading into the PPI print and the Fed. Stocks finished the day strong. Dow up about 0.5%, S&P up 2/3%, and the NASDAQ up just over 0.75%. Markets rallied modestly on Wednesday morning. No news to speak of. PPI, but response to that was muted, waiting for the Fed meeting later in the day. Markets were on the momentum train still, so we did put in new 52-week high in the S&P. The Fed decision were where all eyes were focused, and it was worth the wait. For those of you who like surprises and excitement, in case you missed it, the Fed did not raise rates for the first time in more than a year of increases at every meeting. But as I mentioned, the release is just now known as the beginning of the 30-minute timer before Powell will speak. So the presser was the gotcha moment. It's getting harder and harder to surprise this market. I say harder since, of course, we have more Fed speakers each month than Republicans signing up to run for president. Add in Goldman and the Wall Street Journal, seemingly hot lines to the Fed inside scoop. Hard to surprise, but surprise he did. Skip, yes. Though Powell did catch himself once saying pause, but hawkish skip is what it seems to be. Not one FOMC member seems to think sees a rate cut in 2023, so that should be getting that priced out of the market. 12 of the 18 members expected at least 2 more rate hikes this year. 4 of the remaining 6 think there will be at least 1 more, and the other 2 hold it now. This is not what the market expected, so selling followed for about an hour, up and down all over the place. Overall, the market made it clear we don't believe what you say. We spoke about this on the ups on the way it was going up. I told you then. The reason the markets don't believe what the Fed says is it's forecast. Simply, they're not good at forecasting historically. In the words of the great Yogi Berra, it's tough to make predictions, especially about the future. Just to recap, inflation is transient until it's not. Dot plots are all over the place and changing. When this all started, March 16th of 2022, they said that they still thought we'd be under 1% on Fed fund rates the following year. 15 months later, we're at 5.25%. And what did this do to the markets? March 16th, 2022, the S&P was at 43.57. Wednesday, the market closed at 43.72. After over 15 months of hikes, a bear market, the S&P is fully recovered. Is the patient really ready to leave the doctor's care? Markets totally look past this Fed, as I told you it would. I do want to point out more in a moment, but Powell did say that we don't know the full extent of the consequences of the banking turmoil. Okay, just about everyone out there has put the banking turmoil in the rearview mirror. Does he know something we do not? We'll have to see. After all of this, the Dow finished about 2/3% lower. S&P and NASDAQ both positive. S&P just slightly, and the NASDAQ about 1/3%. Slightly lower open on Thursday with the reaction to the ECB version of hawkish. This time, surprise rate hike and a very hawkish tone. Pretty big differences in what they're facing still, but back home, the U.S. eco data was pretty much gold Goldilocks. Labor market is getting weaker. Bad news is good again. Retail spending is falling, but not off a cliff, as we said about growth as a whole. Price indices are dropping, and that is a key component. If prices fall and growth doesn't fall off a cliff, we may see a soft landing after all. Overall, the S&P 500 hit 4,400 for the first time in over a year. Then it turned sideways. Then FOMO and the chase arrived, another run higher. Then a bit of profit taking near the close, as the S&P did finish at the best level since April of 2022. The Dow finished up 1.25%. S&P also about 1.25%. The Nasdaq up a bit over 1%. Quick summary of some good fundamentals. First, EcoData is pointing to price growth slowing. Still growing, but at a smaller rate than before. But don't confuse the story with too many facts. Along with slowing on the price growth, overall consumer growth continues. Second, market is not pricing in the moves that the Fed is saying they will do. And finally, banks. Remember those things? Powell's not sure, but that index is up over 10%. Thus, sentiment in the banking sector is getting stronger. More data on that in a moment. But let's wrap up the week. Stocks opened slightly higher on Friday, quadruple witching in the long market, going into the long weekend, EcoData was sparse, but the University of Michigan survey, which has been one we watch, inflation expectations fell for the 1 year, and the sentiment numbers went up. From the soft open, the market was red and green all day, not much conviction either way. By the end of the day, the Dow and S&P were each up 1/3 of 1%, and the Nasdaq was down 2/3 of 1%. As we wrap up the week, the S&P was up about 2.5% on the week, and the 5th positive week in a row, the first streak like that since November 2021. It's now up over 25% from the bear market low. Nasdaq up about 3.25% for the week, best since March, up 8 weeks in a row, the best since 2019. Dow was not to be totally left out, up 1.25% on the week, 3rd week in a row, right about the place where 20% up from the low allows the Dow to join the Nasdaq and S&P in the new bull market, technically. I always pepper this video with some daily ups and downs. I want to wrap up today with some facts. There are conclusions to be made. I will not make them here, and some remain to be seen. Some of these favor the bulls, some of the bears. I'll let you judge. First, let's talk about credit defaults. Halfway through the year, we are now already on track to be the 3rd most severe year by default volume. 23 total issuers so far, $25 billion worth. 2020 and 2009 are the only years worse. We'll see how that pans out. This is in line with the overall bankruptcy filings. Venture capital money's drying up, private equity and VC both holding their purse strings a little bit tighter these days, and that makes the environment tough as well. Tom Lee from Fundstrat says that he does not see a recession, and thus stocks can rally higher. Why, you ask? Because the investors' FOMO, he says. I don't know about you, but that's not so comforting to me. As I have mentioned here, with $5 trillion on the sidelines, even at 5%, you may be getting an interest starts to get questioned. If and when that money moves back into the market, the pain trade is still higher. I did read that this seems to be starting to move, but I also warn you, at the top of the market in 1999, the largest ever move into equity funds occurred, and if you need a reminder what stocks did from there, please let me know, until September of 2022, when the largest inflow of money into bond funds occurred. And again, if you need a reminder of what happened, please call me. I'm not saying that we'll see that same market action, but it is some more food for thought. Let's look into this week. What will be the news? Overall, a holiday shortened week, and the news flow is pretty slow too, but slow does not mean boring. Some housing data today, high frequency data on jobs will come Thursday as usual, and though I'm not sure it won't be a sleeper, Powell will be in front of Congress for his semi-annual testimony. Wednesday and Thursday is when that testimony is. Other Fed heads will be, for the week, Bullard, Williams, Goolsbee, Waller, Bowman, and Mester. I think a quiet week will not happen, but the news lends itself that way. We'll see what happens. We're off to a bit of selling today, so let's see how the week turns out. Let's wrap up with a few final thoughts. First, recall that I've said, and I'll say it again, I do think we're headed to the point where the news wires will not lead with Fed heads and meetings. We'll refocus on what to watch in the coming week. It will not have the list of Fed heads. We're not there yet, but we're getting there. And next, speaking of Fed, the next meeting is July, and that's the one markets think we'll see the hike in. Then no meetings until August. No meetings in August. The Fed go to Jackson Hole instead, and then September is their next meeting. There's a lot of eco data to hit between all these meetings. We'll have to see where the data leads us. Finally, and if there's nothing else you hear today, please hear this. Please remember the reason and intent of these market update videos. We need to stay focused on your goals. Each of you have different ones. It may be time to raise cash. It may be time to buy more. It just depends on your goals, your time frame, and your risk tolerance. Please pay attention to the Friday planning videos, and let's get together to revisit your goals, revisit what our actions or should be or should not be now. We're just about done with Q2 in the first half of this year. Crazy as that is. Let's stick to the plan. Let's be clear what that plan is. Have a great week.